Well, good afternoon and welcome to our regular weekly Innovative Business Advisors webinar. We have a really interesting discussion topic here today, but one thing I will tell you up front is that the format is going to be very similar to as it has been in the past. A quick update from Steve regarding the PPP and post-COVID, if you will, updates. And then we will have a discussion. Terry Lammers will be having a discussion or an interview with Julie Pumphrey. And we welcome Julie into the group today. Julie is a new member of our group, so you're going to learn an awful lot from Terry and Julie as they go into a discussion later today. But from a logistics perspective, let's just quickly revisit. We're on the Zoom portal. Within the Zoom portal, you will see a Q&A icon at the bottom of the screen. If you have questions at any time during this webinar, please type your question into the Q&A webinar or into the Q&A portal, and we will attempt to answer that during the webinar today. As always, everything that we're presenting to you will be available after the webinar, so don't worry about taking notes. There will be a recording of the webinar. You'll receive all of the slides, and you will receive a transcript of the Q&A. So with that said, I'll turn it over. Steve Denny, take us from here.
Great. Thank you, Marquita. And as always, we are very appreciative of you giving us your Thursday afternoon. We keep saying this COVID thing is the gift that keeps on giving, and President Trump issued an executive order in August, and we're going to talk about that. It went into effect this week, and I want to just give our listeners a quick highlight of this. You're probably seeing it in various areas of the news media, and we'll highlight a couple of the facts, and then attached to the replay, we will actually have a copy of the President's executive order. So this affects a deferral of payroll tax. I just want to emphasize this is a deferral of payroll tax. It is not at this point forgiveness of payroll tax. It does apply for payroll that's earned from the period September 1st to December 31st of this year. And it applies to any employee whose wage or compensation during any biweekly period is, it actually says here is less than $4,000, but it's $4,000 or less. So, and that's on a pre-tax basis. So doesn't apply universally, but it applies to everybody who makes $4,000 or less per biweekly payroll period. There are no penalties, interests, or additional taxes that apply. Basically, what this amounts to is about a 6.2% wage increase for those that are currently making less than, or equal to or less than $4,000 every other week. Now, per the IRS guidelines, the tax must be repaid before May 1st, and that's May 1st of 2021. One of the interesting tweaks to this executive order is the executive order says that the employer or the employee can choose to repay the deferred tax. So there is some question about whether or not the employer may actually pick up that portion of the tax. And in the executive order, as you will see if you take the time to pull it down from the replay and read it, there is a specific paragraph in there where the President is directing the Secretary of Treasury to explore all available avenues, including passing legislation to eliminate the obligation to pay the deferred tax. So if you see up at top, I said it's currently a deferral, not forgiveness, but the President has ordered the Secretary of Treasury to figure out if there is a way to make this a forgivable program. So maybe a little bit of extra money in the paycheck over the course of the next 3.5 months, and just wanted to provide some of the facts on that. And with that, Terry, I'm going to hand it off to you.
Hey, Steve, quick question. Have you seen anything more about the forgiveness of the PPP loan, kind of carte blanche, if it was $150,000 or lower?
No, it has not been enacted into law yet. They haven't passed any law. I've read some commentaries by various members of the administration exploring whether or not they can do that through executive order. And I don't know whether that's a negotiating tactic to try and get Congress to come to terms, or whether that's something that the administration is seriously considering. But as you and I both know, Terry, it is in the bill that is on Capitol Hill right now. You know, whether it makes it through to the final passage is what we're waiting to see.
Very good. I've had some people ask me about it. I haven't seen anything, so thanks for the update. Well, hey, we're very excited. We added Julie Pumphrey to our team and her team to our team, effective September 1st. Quite the transition. So what Julie, who's all coming over? About 8 or 10 people all together?
I think we have 8. I'd have to count. Let me see.
So, but I guess, why don't you start by, so Julie is gonna officially take over the brokerage division of Innovative Business Advisors, which frees up a lot of time for Steve and I to pursue other things with our CEO to CEO program and valuations and other endeavors that we are going to. So we are super proud to have Julie on board. She is a second generation business broker. So Julie, please tell us about your dad and your current family and what brought you to today.
Well, my dad has been in business brokerage for a long time. He's actually now on the retiring end of it, but he still manages to keep himself involved. He's been in business brokerage over 25 years. A lot of people know him. He was very involved in IBA. He had the biggest office in the country for Sunbelt, if you guys know that franchise. And then he went with Business Team and partnered with Ian McLaughlin. And that's whenever I joined, is they opened up a St. Louis office and I worked there. That's how I learned business brokerage, was under his tutelage. And then whenever I was looking to leave Business Team, Link came to the US from New Zealand. And they were actually the biggest business brokerage in the world, but they were brand new to the US. And so my father decided to join them, and he talked me into joining them as well. And so I bought a franchise, and I was a Link franchisee until August 31st, when Link New Zealand decided to leave the US as far as franchising goes. And so I was trying to decide if I should go independent, and I received some other offers to join some other folks. And when Steve and Terry approached me, I was very interested, and I actually chose IBA because of all the things they're doing right now, and I'm very excited to be involved in all the programs. They have so many opportunities for business brokers to make money and, you know, do things to help sellers above and beyond just selling their businesses. And so I was very excited about that.
Yeah, no, well, thanks. That's very much appreciated. It is exciting, the CEO program. That really has turned a lot of heads, especially when we was doing the webinars with Business Brokerage Press and stuff like that. So I think that's what's so great about being able to bring you and your team on, because Steve and I are really interested in expanding that program to other brokerage firms and you know, just adding an advisory piece onto the brokerage side of it. So, and it's a great opportunity for the other brokers. So you've also done something pretty amazing, which is a first for IBBA, which is the International Business Brokerage Association. Talk about the newly formed association here in St. Louis of business brokers.
Yes, probably about 5 or 6 years ago, Terry knows, but he and I and Jim Brinkmeyer from Murphy and Dave Driscoll with Metro Business Advisors, we started meeting every once in a while, about once a month, just to kind of share listings and kind of touch base. And we felt like, you know, by sharing, we could all make each other's brokerages more successful. And then John Vitale with one of our local banks kind of got involved, and it just kept growing and growing. And eventually we decided that we wanted to become an official association because we wanted to try to raise the level of ethics and the professionalism of the business broker industry here in Missouri, because there's no licensing, no credentialing, no regulation. And so we have worked really hard the last year in doing so. And towards the end of our process, we were working with IBBA, and they were helping us with a lot of it. and they offered us the opportunity to become a chapter, the very first chapter in the United States. And so we actually sign our chapter agreement next Tuesday, and that way it'll be official. But we've been meeting and doing a lot of stuff the last year already. We have a board of directors. We wrote our bylaws. We have a meeting with guest speakers that we bring in to try to help develop business brokers and, help them learn and, learn some things about professionalism. And so we're just very excited about that.
I think one of the things that's really cool about it, because, business brokerage, very much different to the real estate industry. In real estate, it's almost the norm to co-broker a deal, right? And talk about how kind of crazy, and you and I and Steve and Marquita all don't agree with the fact that a lot of business brokers will not co-broker, and how crazy that is. And it's just, I really think that's one of the coolest things about this association is there's going to be much more collaboration and much more co-brokering going on, which hopefully improves the name business broker, and it will be really helpful in helping move businesses. So what's your thoughts on that?
I've always been a big proponent of co-brokering. That's how I was taught. My father, that's, kind of the way that he was raised up in the business brokerage world. And he always pushed all of his brokers and everyone to co-broker. And it just makes sense for so many reasons. First and foremost, when you're representing a seller's interest, it makes no sense to me for you to then close the door on a buyer that might be the best buyer out there. You're supposed to help your seller find that very best buyer. And so when you close the door because you don't want to share with another broker, you're not really performing your duties as you should. But also brokers can make more money because, we work all day long with all kinds of buyers and sellers, and you can do so many more deals when you're out there actually looking to put deals together and not worried about, who's going to make what money when they're doing so. And so at the end of the day, it's just a great opportunity to make more money. And I hear from a lot of brokers, I think the bottom line a lot of times is money, but I also hear that it's, they're worried about the other broker and how much they know or how professional they are, because there's some folks out there that have given us a bad name, I admit. However, that's one of the reasons our association is so exciting, because we're going to have ethics. We're going to have a code of ethics. Everybody's going to sign on. We're going to have an ethics committee that's going to hear violations, and hopefully that's going to raise standards across the Midwest. And then we won't be able to have that be an excuse for people not to get on board and start working together for the best interest of their clients.
Yeah. So you're really go ahead, Steve.
Yeah, I just wanted to say, and this has happened because of Julie's leadership. She's just an incredible leader, comes from a family of incredible leaders in our industry. And, to just build onto her point a little bit, when you compare business brokerage to residential and commercial real estate, 95% of the time, the listing broker does not sell the house. So they may be on the sign out front, but they don't sell it. It's co-brokered through another broker. Unfortunately, on the business brokerage side, that doesn't happen very often. And with Julie's leadership, all that's going to change. And frankly, the big beneficiary of that is the seller, the person that really wants to sell their business. So as we all know right now, it takes on average a year to sell a business. But you could put a comparably priced home on the market, and typically, depending upon what geographic area you're in, it will sell in a much shorter period of time. And the vision of co-brokering will really incur to the benefit of the sellers in the marketplace, and provide buyers with a much broader field of real quality businesses from which to choose.
Yeah, and I mean, I think that the myth that you got to kind of get through against the anti-brokering thing is, yeah, you may be splitting your fee, but you're going to sell more businesses, and if that spins off a positive attitude, then you're going to get more people that want to list through a broker. So Steve, to put a cheap plug in for your book, Julie, we'll get back to you in a second, but this is just kind of a perfect segue into Steve's books. You know, your book, it's coming out this fall, Steve. The second book in the You Don't Know What You Don't Know series is about the experience of two people, true life situations. One used a broker and one didn't.
Yeah, and the outcomes were remarkably different. So it'd be a nice, hopefully it'd be a nice contrast that will help people really understand, you know, how we make the sausage in such a way that it's easily understood for buyers and sellers in the marketplace.
Yeah, cool. So, you know, Julie, talking about that, you've obviously grew up, you know, with your dad owning a business brokerage company, and you've done it for a long time. In your mind, what really helps make a business sellable?
Well, there's several factors. I think number one is that it's profitable. And then it's also important to have it be with numbers going up. You want to see revenues and profits increasing. Staying the same is okay, but numbers going up makes it a really easy sell in the most times. Another one that you want to see is good bookkeeping, good financial records. You don't want the owner using the business as his personal checking account. So, you know, as long as they have clean books and records, ideally you'd talk to everybody a few years out so you could tell them that so they could clean it up a little bit before you actually list the business. Another thing that's really important is that the owner is not the business. So the owner, again, you talk to them a few years out would be ideal, and you tell them, hey, make sure you're not the face of the business. Hire a manager, make sure everything you can do, someone else in your business can do. So, you know, those are probably the top ones that I would think.
Yeah, isn't that crazy? It's the non-financial things like the owner being overly involved. I tell people that all the time. It's like, you know, non-financial things that are going on in a company, and you know, in our coaching program, we usually talk about 8 of them basically, you know, and the owner being overly involved. It's not like it lowers the value of the company from $1 million to $800,000. It can really determine whether the company's even sellable, you know? So, talk about the importance.
It did lower the value.
Yeah. So
right now, and he's the #1 sales guy, and so if he walks away, that business's revenues and profits and everything are going to go down about 70%. And so, you know, it really affects the value.
Yeah, that transition is very important. So talk about the importance of putting a fair value on the company. I mean, so we talked about it in our meetings yesterday, that it's not uncommon for a business owner to come to us and having a lower expectation of what the value of their company is. But what are the dangers of overvaluing a company?
That it won't sell.
That's pretty simple, right?
I was going to say, and you'll turn buyers off. So you'll have buyers not even want to look because the price doesn't make sense with what they see. And so in order to get them to look deeper and fall in love with it, you know, if we can't even get them to take a look, you know, that's a problem.
Yeah, that's frustrating. So I know when, you know, when we was kind of courting each other and if he was coming over or not, one of the things in the valuation piece was the bankability method. You seem to like that. What do you like about the bankability method of valuing a company?
Well, we were doing, it's called the cash flow method, which is similar. But if the business doesn't cash flow and it doesn't make financial sense for somebody to buy it, or if they buy it and then they get in trouble because they can't make the payments or they can't survive on the amount of money that the business makes, it's going to be, you know, a serious situation for everybody. So, you know, you have to set your buyers up for success. And so knowing that financially they can afford it, they can make the payments, and it's going to allow them to feed their children and pay their bills, those are all very important things. And then as far as bankability, you also have to make sure they can even get a loan to begin with.
Yeah. So how many banks do you typically work with in a deal? I mean, is there a number of bankers that you work with? Most of the deals, a fair amount of SBA deals, you know, talk about the process of going through the bank and how a broker can assist with vetting that process.
Well, whenever I get a listing, one of the first things I like to do is send it to some bankers and kind of shop it around and see who likes the deal, what kind of terms they're willing to offer on it. And so there's a number of banks here in St. Louis. I also work with a couple of national guys. And, you know, after you do this for a while, you usually learn kind of which banks like which kind of deals. But it's always nice to have a few different ones look at it just so you know, kind of know where you're coming from and can pick out a good one. But then depending on the size of the deal, you know, it makes sense for buyers to at least look at, you know, 2 or 3 banks just to see what works best for them, you know, who's going to give them the best terms, all those kind of fun things. And as far as what we do with them, you know, as much information as you can get wrapped up in the beginning, you know, and package it and send it over to the banker, the quicker that you can get a yes or no, and the less work it's going to be for the buyer, and the faster the time period is going to be, because otherwise you're going to be stringing the information along and the banker is going to call and ask for another thing and it'll take forever.
So you've experienced that.
Oh, yeah.
So it's kind of funny. It's like the reverse, again, not to bring the real estate up again, but it's really, you know, you see commercials about the buyer being pre-qualified to, you know, what they could spend to buy a house. But in, you know, our situation with business brokerage, it's like you're pre-qualifying the business so that the buyer can step in and buy it.
Yes, and actually I'm very excited because several of the bankers that I work with are now beginning to pre-qualify buyers for me, which is kind of new to the business brokerage world. And so I really like having a buyer that I already know has a bank that they've already done all the work with to get pre-qualified. You know, the bank's on board. They've said how much they're willing to lend. They've said, you know, what kind of industry. I mean, it's kind of like on the flip side. And so you have that, you can really put a deal together quickly.
It's funny. The fastest business I ever bought was in 3 days. Found out about it on a Wednesday and it was a done deal on Friday. That's definitely not the norm. So tell us, so you've been doing this a long time. What's one of the craziest situations you ever seen?
Oh my gosh, you should have given me advance notice. There's been so many. Every deal is different, and it seems like every deal can have its own little crazy moments. I don't even know. I'd have to think.
I'll let you think on that. But here's another thing I wanted to bring up, because I think this is important and it kind of falls under the you don't know what you don't know. But talk about the listing agreement, and because I've seen some horrible situations with the hook and just you know, I think we have a very fair listing agreement. So can you talk about the goods and the bads, and, you know, to the tune of you don't know what you don't know, what should somebody be looking at, you know, if they're comparing one brokerage company to another?
Well, and I don't even know if it's necessarily the listing agreement, but a lot of things they should look at is, first of all, the experience of the firm. And a lot of times a brokerage that has more than just one person is good, because then they're going to have a little bit more inventory and a little bit more experience, because, you know, that way you can all share deal experience. And so when something crazy is happening, you can go to one of your coworkers and, you know, talk through the deal and get some help. But also if they co-broker or not, and how they handle agency, because those are important legal things. You know, how long they're willing to take a listing agreement for. IBA says it's about a year to sell a business. And so a lot of times brokers are so focused on getting listings, they don't even care what the term is, because they don't care whether or not they're going to sell it. And that's always a concern. And, you know, there's brokers that can have hundreds of listings, but if they don't sell the majority of them, they're not doing anybody any good. I'm trying to think, is there, I don't know, is there anything?
You know, I've seen listing agreements where I call it the hook, where say there's a year, you get the listing for a year, but there's language in the agreement that, you know, if you sell your company up to 5 years after the listing agreement expires, that brokerage company is still supposed to get their commission, whether, you know, whether you introduce them to that buyer or not.
Yeah, I mean, that's ridiculous. I don't even see how legally something like that could stand up in court. As a broker, you want to protect buyers that you've been working with and showed the business. However, as a seller, you don't want to be on the hook forever to somebody that was obviously unsuccessful in selling your business in the first place.
Yeah. So you mentioned Link, your former franchise was out of New Zealand, and I believe they also had offices in Australia. It's very interesting. Talk about, you shared with me one time the differences in selling a business in different countries compared to the United States.
So Link is in New Zealand, Australia, the Philippines, and they were in South Africa, but they left whenever it got a little bit crazy and violent there. But it's amazing because the majority of the world speaks English, but they speak the Queen's English. And so the Queen's English is very different from US English. And since my father was actually a 50% partner with Link USA when they came to the US, and since I was franchise number 2 after him, I actually was involved before I even had an official franchise agreement, and I was involved in a lot of the beginning stages. And none of us realized at the time what it was going to be like, but we soon learned that nothing that worked in Australia and New Zealand or Philippines was going to work in the US, and it wasn't a language issue. It was that everything is different. Attorneys do different things, accountants do different things, they have different tax systems, they have a different monetary system. You know, they go through the whole closing and listing process significantly different. The brokers and law related to being a business broker is different. It was just amazing. Even our paper size was different. So we pretty much had to start from scratch and all those systems.
That's kind of crazy. I didn't know that you would have thought 8.5 by 11 is a standard.
Nope, it is not. And so we had to even documents we could use for marketing pieces and such, we had to translate them, and then large sections of it were not applicable because they meant different things in different countries. They have words. For example, a vendor. In America, we look at a vendor and we think that a vendor is, you know, somebody that we buy goods from when we own a company. Well, in the rest of the country, or in the rest of the world, a vendor is actually a seller of a business. And so in every single piece of paper that we had, it was like, you know, we had to clarify what a vendor was.
That's great. So you bring over a pretty good team to Innovative. You want to talk about a few of your team members and their strengths? And I know we're also looking for you especially, different types of brokers. So talk about your team a little bit and people that you would be looking for, especially to join Innovative.
Yes. So right now I have Jim Brinkmeyer. He has about as much experience as I do. He actually started out with Murphy. If any of you know Murphy Business Brokers, it's a franchise. And he worked under someone else for a couple of years, and then he bought his own franchise. And so that's whenever I got to know him, and we got to know each other through co-brokering deals and working together. And after Roger Murphy passed away, he was kind of thinking that he wasn't really interested in doing that anymore. And so I was very fortunate that he came and joined me. I asked him to, and he did. And so I love Jim. A lot of people know him across the US, and he's so very good at what he does. He has a great background. And then I have Howard Hughes, and Howard travels all over the US doing speaking engagements. He does business consulting. He's just getting ready to turn 30 this month in about a week or two. And Howard, for his age, is one of the most amazing men I have ever met in my life. And if you ever get an opportunity to hear one of his speaking engagements, or even check him out on YouTube or on Facebook, some of his videos and things, you will be impressed.
Well, Julie, it sounds to me that we know who our next guest will be on the webinar, right?
He's really good at speaking, and so you guys would probably really enjoy hearing from him.
What's the name of his book?
Oh, see, you keep putting me on the spot. I don't even know. I have a copy of it in the other room.
Google it, right? Howard Hughes, Hughes, right?
Yes. Or if
Yes.
you just look on our website, I think he mentions his book maybe in his bio. I don't know. Maybe we should add that to his bio.
We need to get his added to our list. So
Yeah.
exciting. So what about the people? I know you've got some specific people that you'd like to add to the team.
Yes, I was gonna. Well, and so the rest of my team is
Oh, yeah.
new, and I have educators and I have business owners, and those are the type of people, salespeople who have worked doing a lot of sales are sometimes good. I love previous business owners. They really understand the ins and out of business. People come from finance. Those are good people, unless they have a hard time communicating, because you have to be able to communicate with sellers. And then, you know, people, so I'm looking for people in finance, you know, people that have worked with SBA financing. Right now I'm working on getting a SBA banker on board. He'd be an excellent business broker. He's very good at networking and getting deals done. And so it would be a natural transition for him to start doing them completely instead of just on the finance side. Is there anything else you were kind of wanting there?
No, I think you're covering it. If anybody's got any questions, so, you know, this is kind of a deep dive into how the business brokerage world works, and it's really, you know, neat to have Julie on and talking about it. So if anybody's got any questions, please feel free to type them in the Q&A section, and, you know, we'll get to it. You know, it's interesting, as a former business owner myself, it's kind of crazy. When I owned the oil company, I didn't even know business brokerage really existed. So, you know, I think some of it does fall under you don't know what you don't know, you know, and can be a very positive experience and very helpful experience, because we help answer all those awkward questions, right, as you're going through the process.
Yes.
So Terry and Julie, this is Marquita. We do have a question in the Q&A box. Nitin asks the question, do you charge for business valuation? If so, what typical charge for valuation for a small business with revenues between $1 million and 20 million? Also, can anyone do a business valuation, or does it have to be done by a licensed appraiser only? Great question. Terry and Julie, you might want to address that.
That sounds like more your line of question, but.
So, okay, I'll tackle that. So what was the, is it Minton?
Nitin, yes.
Minton. I'm a CVA, Certified Valuation Analyst. That's a national designation. You know, Julie and Steve are not CVAs, but I would trust their valuations as much as mine. You know, one of the main things at Innovative that we really hang our hat on, and I'll say this all day long, and I just wrote a white paper for NACVA, the association, about this, is putting a fair price on the value of the business. It's the #1 deal killer if a company's overvalued. I talk about several stories in the paper of, you know, I just had one recently where a fellow CVA valued a HVAC company at $1.3 million. And it was not a bankable deal. And the plan was to sell it to a key employee who happened to be his nephew. And, you know, so he paid $10,000 for this valuation, and it came back with a value of $1.3 million. So he was pretty adamant, the owner, that this company's worth $1.3 million, but it was not a bankable deal. And after several failed tries by the nephew to buy the company from banks because it wasn't bankable, the deal fell apart. There was a lot of hard feelings, and the nephew quit the business. So this business had 2 HVAC techs and 2 plumbing personnel. One of the HVAC techs was the owner. So when the nephew left, who was the other HVAC tech, now the only one left is the owner, and he's in his late 60s. He has health issues. And, you know, kind of a thing about the HVAC business is those guys are all very, very busy. And it made for a situation that the company was unsellable because nobody was willing to take on their customers because there was no techs to go along with the business. Well, by the time they found themselves to me, I valued the company between $400,000 and $500,000. $450,000 would have been a very bankable deal. But now it was a non-financial thing that we kind of mentioned earlier that nobody would take it on. And unfortunately, this company ended up closing its doors. So, and there's just several situations like that, right, Steve? Go ahead.
Yeah, absolutely. And I'd like to just weigh in, and for Nitin's benefit, talk about what is, you keep saying bankable. What does bankable mean? Well, bankable is if you sell the business to somebody, is there enough cash generation, profits, think of profits, just owner's discretionary profits, is there enough money to be able to service the debt on the business, and for the buyer to be able to make a living, and for the business to continue to have enough working capital to sustain itself? If those things aren't present, no bank will lend against that business, and thus the deal is not bankable. So when the number is too high, when the valuation is too high, and the deal becomes unbankable because it would take all the available cash of the business to service the debt, and it wouldn't leave anything left over for its owner or for the working capital of the business. And that's what we see happening so often, that is a big deal killer. So we really focus a lot on valuations, particularly for companies like Nitin's that are between 1 and 20 million, where the valuation is bankable, because when you have a bankable deal, then you can sell it to anybody that has the qualifications to run the business. And that makes sure that the owners get paid at closing. They don't have to carry some note that may never ever be able to collect on over time, because the deal's not bankable.
Right. So, Minton, I'm not dodging the other part of your question about price. So in my example, it is not unusual for valuations to be in the $10,000 range. And obviously, the bigger the business, the bigger the bill. But this was a very small business, and he still paid $10,000. I think that's, well, let me reframe that. That's not high, depending on what the use of the valuation is for. So at Innovative, we say we have two
Primary
valuation levels. One is what we call certified valuation. So that is 100% per NACVA's standards. And that means there's a complete write-up on the history of the company, the management team, the industry that you're in, what the economy's doing. The key word is write-up. There's a lot of work that goes into putting that all together. And if the reason for your valuation is divorce or something that's going to be litigated, that is a necessary evil. And it's a lot of work. So $10,000, I would tell you, is a fair price. And we won't do one for less than $10,000, what we call a certified valuation. We also do what we call a summary valuation. So with a summary valuation, there's not a lot of write-up about the company. There's not a lot of write-up about your management team or the industry. Typically, our summary valuations are being presented to the business owner for the purpose of transferring the business. And you don't need to know about your management team or industry. You're living it, right? So we just kind of there's some language in there about the approaches we use, and we get straight basically to the numbers. And we charge $3,500 for that valuation. And I think that's a very fair price. And it's still, for that, it's still if your buyer is going through the SBA, any SBA deal with over $250,000 of goodwill, has to have a business valuation, and our summary valuation still qualifies for that. So I'm very proud of the valuations that we do, and I think we put a very fair number on the companies, meaning we don't overvalue them. Now, if you Google it, yes, you can go somewhere and find a valuation on the internet for $500. But I mean, beware, because in a lot of these valuations for $500, it truly is, you get what you pay for. A lot of them ask for you, the business owner, to put the information in for the purpose of the valuation. So when I ask you, what's your depreciation? What's your is there any normalizing entries? Meaning, what is going on in that company that you may be taking money out personally that a future owner wouldn't have? I mean, those are all series of questions that we go through. The rents and stuff like that. So basically what I'm getting at is, if you're gonna pay $500 for a valuation and you have to input the information, but you really don't know what you're inputting, it's garbage in, garbage out. The other thing is, they are typically using an algorithm to come up with the value of your company. So if your sales equal this, then the company must be worth that. Or if you're in this NAICS code, business classification, well, then it's automatically this. I totally disagree with that. And I've gone round and round with other companies who want to push an algorithm to value a company. It just doesn't make sense. So,
And Terry, I'll build on what you just said there because it's so true. I have seen your presentation where we talk about value, and the scenario is that the gross revenue of the companies are the same. We're comparing two companies, and there's some intrinsics about how those companies are run, managed, and historically their potential for going forward. Things as simple as how aged is your equipment. The one company may be valued a certain way because they are pretty fresh in terms of having refreshed their equipment base. The other one may have everything about ready to break down. Is it possible, even with the same revenue base, that those companies are going to be valued the same? And Terry, that's what you do.
Yeah, and that's very difficult. So here's what, I tell people all the time. When we're valuing a company, we're valuing the current cash flow of that company. And that is what I call a financial valuation. We're valuing the current cash flow of the company. There's also a strategic objective to buying companies. So I talk about a situation in my book where I had a competitor between, I had two offices 30 miles apart, two bulk plants, petroleum storage facilities. And there was one in the middle. And in my opinion, he wanted $100,000 too much for his company. This was a smaller company, one-man operation. But he had a very steady client base. But obviously, I had a very high customer concentration rate in this area. And me and my accountant used to always beat heads because he's always like, you pay for a company for its current cash flow. And, I'm looking at the strategic value. Well, the last thing in the world that I wanted was a competitor to come in and buy that bulk plant right between where I had a very, two other ones in a high customer concentration area. So did I pay him $100,000 more for it? Yes, I did. And I tore his bulk plant down. Nobody else is going to build one. But here's the other thing to think about. If you looked at his current cash flow, I paid him too much. But for me, from a strategic standpoint, I eliminated literally probably 60 to 70% of his operating expenses. So, from a strategic standpoint, it was still a very good purchase. So there's so many little things to look at, the value of equipment, software. I bought another company after the oil company days, and it's about the due diligence questions. And we really got burnt because we didn't ask the right due diligence questions. We got in there and the phone system was shot. The computers were shot. The employees hadn't had a raise in 5 years. It was like, ugh, every time we turned around, we was getting dinged. And those are all very important things that you have to pay attention in the due diligence process of buying a company. And really, Julie, wouldn't you agree that's really where the value of a broker comes in helping you through those due diligence questions, right?
Yes. I have a good example of how that works too, because we had a gentleman, he had a printing company, like the manufacturing type of printing, and he was going to sell to somebody that he knew, and he was going to sell for $300,000. And so this is a small deal, but he came to us and we explained to him that we would at least like to do a valuation. We might be able to get more money for him. And we did a valuation, and his business was worth $450,000. The other guy didn't want to pay it, so we took it to market. We listed it. We got him an offer for $450,000, and then the other guy came back around and wanted it. So,
So Steve,
value is so important.
Yeah. So Steve, you have a process that you call the Dutch oven. And I guess so before I want you to tell that story, I just want, the people in general, it's like, there's a zillion ways to structure the deal of a company, right? So Steve, talk about your manufacturing company that what was it, last year or the year before that you sold, in the process you went through to do it?
Yeah, we had a client that came to us last year, and they were looking for assistance to go through the process. So this is a person that owned the company for many years, and they had an offer to purchase from an interested buyer, and they were excited about that, and they were looking for somebody to walk them through and help them through the transfer process, the due diligence process, if you will. And when we saw the offer, we said, you know, are you really sure that this is what you want to sell the company for? And he was comfortable with the offer, but he said, you know, I really don't know what the company's worth. Do you think I'm leaving money on the table? And his offer was for $1.5 million. And we said, yeah, we think you're leaving at least $1 million on the table. And he said, well, if that's the case, I would be very interested in learning how we could, you know, realize that extra $1 million. And basically what we did is we put together a process whereby we knew there were a number of interested parties in his business. He was very well known in his industry. So we sent out a solicitation to all of the competitors in his marketplace that had expressed an interest in his company. He ended up getting 18 offers to buy his company, and it was quite an exciting process of negotiating that down. We went into a small group of the best 5 offers, and then took it down to the best 3, and then ultimately ended up working with the best one. But he ended up selling the company for more than twice what his original offer was. And he and his wife were tickled pink with the process, and the buyer was tickled pink with the process, and everybody walked away from the deal very, very happy. So, you know, I think a couple of things about that. I think having an offer, an unsolicited offer, you know, our next book is called A Step-by-Step Guide for Getting the Most from the Sale of Your Business. Just because you've got an offer in hand doesn't mean that it's necessarily the best offer. And one of the biggest things we find from sellers who walk away from a process like that is they always wonder, did I leave any money on the table? And if there are some facts that come to light in the future that they did leave money on the table, they become very remorseful about the sale. And that's not a good outcome for the seller. Obviously for the buyer it is, but not for the seller. We like to create win-win solutions and make sure that we've got a good, fair, bankable deal for the buyer and the seller. And in those situations, everybody walks away really excited.
Yeah, Nitin, that was a great question. You got us going down to like, meow. Got me excited. You know, I talked about the company that I bought in 3 days, and we haven't talked about this either, but it definitely falls under the 101 ways to sell a business, is an earnout. So I had a situation where a call came into our office, and it was a customer looking for a new fuel supplier. And at the time, it was my mom that answered the question or this call, and she said, well, why are you looking for a new fuel supplier? And she said, well, my guy's going out of business. So I got back into the office, and she told me about it, and I called the supplier. I said, hey, heard you're going out of business. What's the deal? And the owner had died, and the company started losing money, and they was going to close their doors on Friday, and this was a Wednesday. So I said, what are you doing with your customers? He said, I'm just letting them go. And I said, well, hold the door. I'll be right there. I drove to Fallon, Illinois, which is 30 miles from me, and we worked out a deal where any customer that he referred to me, I gave them 25% of the gross profit from that customer for a year. So I paid him a very fair price for their equipment. And it ended up where, you know, they was going to close their doors on Friday and not get anything. And they ended up getting a couple $100,000 from the sale of the company, just because I worked out a very fair deal and got all of these clients. So that's another thing. If you're listening and you're a seller, or you know, you're a business owner, a great way to grow your company is through acquisitions. I mean, you really got to explore that. I mean, that's how I grew my company, was through a series of 11 acquisitions. So, I don't know, might be another book in there, Steve. So we're getting close to time here. We're about 10 minutes to the top of the hour. Julie, thank you very much for being on. Your wealth of information, pioneering and quality individual. And you know, Steve and I and the rest of us are just tickled pink to have you on the team with the rest of your team. So thanks for being on today. Kind of looking forward to next week. Steve, we got a very exciting guest next week. You want to tell us a little bit about our guest next week?
We do. We've got an owner of a Chick-fil-A restaurant coming on, and you know, the theme and title of our webinar series has been survive, pivot, and thrive. And boy, if any industry has been affected by this strange Chinese visitor, it's been the hospitality industry. And, you know, Chick-fil-A has made some amazing changes in their complete business model in order to do exactly that, survive. They've pivoted their model and they are literally thriving. I think anybody that has ever driven by one of their restaurants right now sees that the lines are, you know, out the parking lots into the neighboring streets. So those folks are doing really, really well, and we're going to have one of their key owners come on and give us some of the secrets behind all of the things that they had to do to get into that position. So it should be a really interesting webinar.
Yeah, I'm excited about that. It looks like we have a follow-up question about a broker's opinion of value. And, you know, do you have to be a CVA such as myself to value businesses? You know what, it's really my opinion on that, and Steve and Julie, feel free to chime in. Well, so for one, whenever we list a business, we give you a valuation of the company. And I know, Julie, you kind of did some broker's opinion of value. And more than anything, I would lean on your experience, because, you know, the way Julie values the company and I do might be coming at it from two different angles, but at the end of the day, I think we're both pretty much on the same page with where it's at. So, you know, real estate business, you can get a broker's opinion of value also. I think it boils down to experience. Julie, you got any comments on that?
No, I was going to say, so I never got any certification or anything, but I've been doing valuations for about 15 years, or broker's opinions of value, because I don't go to court. And I explained to all my clients up front that if they wanted to go to court or had it be certified for any legal purposes, they needed to get the full-blown valuation, the one you paid $10,000 for. But as far as helping them figure out a price to market their business, I think that, you know, it's something you have to learn, of course, and the more you do it, the better you get at it. But, you know, as long as you get the right education, you can do it.
Yeah.
The word of caution that I would throw in there is that you don't have to be certified to directly answer the question. However, it depends upon what the purpose of the valuation is. And Terry, you alluded to this earlier. If the purpose of the valuation is you want to get a valuation because you're getting to where you want to retire and you want to hand over the business to somebody else, then you need to use a valuator that is very, very comfortable with business transition valuations. If the purpose is you're getting a divorce from your spouse and you're having to split the assets, you know, there are valuators that focus specifically on those type of valuations. So it just depends upon what the purpose of the valuation is, and find an evaluator that is very experienced in doing valuations specifically for the purpose that you need one.
So Nitin, I just sent you the website to the book, and Steve's book will be on there shortly. You don't know what you don't know. In the book, I tell the story about, you know, you want to, so to Steve's point, go to somebody that's got the knowledge, and Julie, you know, experience. In the book, I tell a story about a person that came, I just started Innovative really, and he's like, guy calls me, he's like, I don't need a broker to sell my business, but I would like to pick your brain a little bit. So I tell him to bring me in 3 years of financial statements or tax returns, and shows up and he kind of flops them on the desk, you know, and it's like, you know, he's looking for an answer right there, right? So I start kind of looking through them, and I asked him, is there any add backs? He's like, what's an add back? And I said, well, is there any personal expenses that the business is paying for that the new owner wouldn't get, you know, wouldn't have to pay for? And he looks at his wife, and, you know, they're both in their mid 60s, and he goes, nope, mom takes care of the books, everything's squeaky clean. I'm like, well, all right. And I look again, I said, well, I don't know. I think it's probably worth about $250,000. And he looks up at the ceiling, and she looks out the window, and it's like, uh-oh, that wasn't the answer they was looking for. And about that time, there's a tear rolling down her eye, her cheek, and I'm like, oh boy, time out. Okay, it's like, okay, time out. What's going on? And he said, well, I have sales of 1.3 million. So I was pretty confident that this company was easily worth over $1 million. And it's like, no, that's not how it works. It's all about the cash flow. So it's one of my main mantras. It's not about sales and net income. It's about gross profit and cash flow. So about that time, the wife pops up and she says, you know, our credit card is $5,000 a month. And that's all, you know, groceries, gas bill, all personal stuff. I'm like, well, there you go. That's $60,000 a year back into cash flow. And we talked a little further, and the company was maybe worth $500,000 at the most, but that couple left the office. I just wrecked their retirement plan in about 1 hour. So that's, really the importance of getting a fair valuation on a company. And I would argue that any company in any stage of their business should be valued so they know where they're at and get a fair valuation, whether it's from an experienced broker like Julie or Steve, or somebody that's got a certification, as I went through the process to get. So, very important. So,
it's so important that we actually sell a special service to business owners that we call a subscription service, so that every other year we update their summary valuation to keep them on track and accountable for the fact that they are actually growing business value in their company, particularly for those that are getting, near or at retirement age. So, you can't change the valuation of a company overnight, but if you have a concerted effort towards it, you definitely can affect the company's valuation in the course of a couple of years. And if anybody out there is in need of learning more about that, all four of us here are happy to talk with you about that.
Yeah. So, well, Marquita,
Okay.
we're keeping up on top of the hour. You want to take it back over?
You bet, Terry.
Terry.
I'm looking at my computer and I'm saying yes, definitely. We need to start to wrap up. So my process for wrap up. We each go through, have an opportunity to give our final words based on the topic for today. Before we move to that, I just want to say to Julie, thank you so much for joining us. I'm really excited about the partnership, and I'm looking forward to that going forward. So in order to wrap up, I'm going to go in this order. I'm going to give Terry the first shot at it. Steve, you'll go second. And Julie, you get the final word today as we wrap up. So Terry, take it away.
Yeah, so I'm happy to announce anybody on. I'm going to be a speaker for what's part of Enterprise Bank and Trust. They have what they call Enterprise University, September 10th. And I'm going to talk about 10 ratios business owners should know. It's a part of our CEO to CEO program. Steve, if you go to the next page, if you go there, you can register enterprisebank.com/EU. There's no fee for it. It'll be a great presentation. It's a 90-minute deal. Very much looking forward to it. Please register. Even if you can't make it on September 10th, you'll get a recording. So should be a good one. So thanks.
Okay, Steve, take it away.
Well, I think everybody will agree. I mean, Terry and I are very blessed to have Marquita and now Julie and Julie's team as part of the group. So Julie, we're very honored that you join us. You guys are absolutely outstanding, and we're just really excited to work with you. So thanks for making the time today. I know your life is incredibly busy right now, and really excited to work with you in the future. So thanks again.
So Julie, you have the opportunity to say the final word on the webinar today. The floor is yours.
Well, I would just like to kind of answer to what Steve said, and I would like to say thank you. And I feel like I'm the one that's blessed. Me and my team kind of had a home to go to, and so we just really appreciate the opportunity. I think you and Terry and everybody over there at Innovative they're just borderline genius, and you guys have so many things going on right now that I'm so excited to get to be a part of. And I just can't wait to see all the things that we accomplish in the next few years.
Okay,
Julie,
thank you for those kind words. And then to all of our participants who were in the webinar with us today, thank you for joining us. We will be back next Thursday afternoon, same time. As always, all of the information presented today will be available. The links should be up on our YouTube channel, the Innovative Business Advisors YouTube channel, with additional links to our Google Docs area. So you will have copies of the presentation, copies of the Q&A, and a recording of this webinar. So with that said, good afternoon, everyone, and have a great week. And it's holiday weekend, so enjoy your Labor Day holiday.
Take care.
Bye-bye.